Okay, guys. So did the professor tell you whether the final gonna be cumulative or not? Cumulative, right? Would it be a departmental exam? No. So each professor gave his own exam. Okay. All right. So not many people here today. So let's have a 2-hour session. And if you still have any question, Oliver has to leave. He has a busy day. He has other sessions to work on. And we can stay. And if you have questions, we can discuss. I don't have slides for previous chapters, but if you have any question for your revealing, and you can ask me, and we can have a discussion. Okay. Okay. So today, but we are going to cover 11, 12, chapter 11, chapter 12, risk and return, and capital budgeting, and how to for the first several chapters, what we talk about is return, right? But in these 2 chapters, we are talking about how to measure risk, and how to compare risk and return and form a good portfolio, right? Capital budgeting. So that's the topic of chapter 11 and the 12. So let's start from 11. Same thing, same as my previous sessions. We'll go over some important knowledge and principles, and followed by questions in our question list. Okay, feel free to interrupt me if you have any question. Right? So these are the 2 formulas we have seen for many times. Right? The percentage return consists of 2 parts. One part from the capital gain, the other part from the dividend. Okay. And the 2 parts sum together divided by your initial investments or initial share price, okay? And the real rate of return is just a nominal rate of return divided by the inflation rate, okay? These are the 2 formulas important. This chapter started with these 2 formulas, and you should be able to use those 2 formulas to do any calculation, okay? Say you have a stock, you bought it at $100. A year later, the price increased to 102, and during the time you got the $1 dividend. So your percentage return would be 2 plus 1 divided by 100, right? And real rate of return, you have, I believe you know how to use it for calculations, right? Okay. To measure risk and return, we need to have some benchmark. And the market portfolio is the benchmark. But how to define the market portfolio? There are different methodologies. Okay, market index is a portfolio of the whole market. But what is a whole market? It's hard to find the whole market, right? Stock market, bond market, derivative, we have to add them together, but it's very hard to define that. So there are some index that it consists of a part of the portfolio, but pretty much representative for the whole market. So Dow Jones Industrial Average, it consists of 3 blue chip stocks. Blue chip stocks are those quality, reliable stocks that you can hold and pretty strong during good time and bad time. Okay, 30 blue chip stocks. But the drawback of the Dow Jones Industrial Average is only 30, right? Only 30 stocks. We have hundreds of stocks on the market. It's not that representative. Also, it assumes you hold 1 share for each stock, which is not realistic because we all know different companies have different number of shares outstanding. So for an average investor, he must hold like different numbers, on average, different numbers on a stock than the other, right? So if you assume one share for one company, it's not that realistic. So, so Standard Poor's Composite Index is a little better. It includes 500 larger stocks, and it also includes the number of shares of each stock proportional to the total shares of total number of shares outstanding. So it's more representative than the Dow Jones in terms of representing the whole market. Okay, so these could be multiple choice questions on the comparison, like comparing different types of index. Okay. And then when we ask, okay, start from return, right? Return and the risk. When we ask what return we require from this specific stock, there are different methods. You can say, okay, we use historical returns, but historical, they are good or bad. We don't know what historical return to use, and the common method is to find a return by using the base return, the base risk-free return plus some premium, based on maturity, based on risk. So a stock's return should be some risk-free rate plus the risk premium, which compensates for the actual risk you take on top of the risk-free securities like treasury bills. So there are two kinds of premium. One is maturity premium. That is a premium, that's a compensation for waiting for a long time. Say the return you require for a treasury bond. Treasury bond and treasury bill, they are both riskless. Okay, they are both safe. But for treasury bond, you have to wait for a longer time. Okay, and by waiting for a longer time, your future cash flows are subject to interest risk, right? We have talked about that. They are more subject to interest rate. Their prices fluctuate more with the change in interest rates. So we have to compensate for that longer waiting time. And the premium that compensates for that waiting time is called maturity premium. Okay, so that's for the treasury bond. And for the risk premium, that's for the stock. Stock, we have returns. This is not riskless security. We have to take the risk of a price going up and down. So to compensate for that risk we are taking, we are requiring a risk premium on top of risk-free rate. Okay. So the rate of return on the stock is just a risk-free rate, interest rate on treasury bills, plus market risk premium. Okay, the premium or the compensation you require for taking on extra risk. Okay, and if you look at the average return for first the two are riskless, but the first one is short term, 3 months, and this could be more than 10 years. Okay, and the common stocks, they have different rates of returns, and the difference between 5.2 and 3.9 is a maturity premium. 11.5 minus 3.9 is a risk premium. Okay, the actual return we require for waiting and for worrying, right? So waiting a longer time or worrying about the risk. Okay. Okay, that comes to the question 2. The primary difference between U.S. Treasury bills and Treasury bond is that they don't have any. They are considered riskless. For Treasury securities, we consider them as riskless, regardless of longer maturity or shorter maturity. So the difference is that they do not have default rate. That's the common, right? The common feature between the two. More price volatility, have a shorter maturity at the time of issue, offer a higher return. Okay, so the answer is C. They have different maturity. Right? They have different maturity at the time of issue. That's a major difference. The risks are the same. Okay, they are riskless, and for the treasury bills, they don't have a higher return. They have lower price volatility, and both of them do not have default risk. Okay, the answer is C. Maturity premiums offered on long-term treasury bond due to the risk of changing interest rates, the default risk, the specific risk, or the uncertainty of the maturity date. So that's A, right? The maturity premium compensates for the longer waiting period in which there are price change responding to the interest rate change. Okay. Okay. It's not the uncertainty of their maturity. Their maturity date are certain, right? Their maturity date are certain at the introduction of the bond. The default risk, there's no default risk. There's specific risk. It's not specific. We're going to talk about specific risk and market risk, but it's not in here. So the maturity premium is a compensation for a longer waiting period in which there are going to be price changes responding to the interest rate change. In a year in which common stocks offer an average return of 18%, okay, well, we need to move it down a little bit. Okay, of an average return of 18%, and
Treasury bills offer 7%. So the risk premium of common stock. So it is just their return minus the risk-free rate. So it's simple. 18 minus 7 is 11. Okay. So these statements are from the textbooks. Okay, let's read. I think these are important for understanding this chapter. So firms calculate the present value of a new project by discounting the expected cash flows by the opportunity cost of capital. Okay, what is that? What is opportunity cost of capital? It is the return that the firm shareholders are giving up by investing in this project instead of another project with a comparable level of risk. Okay, that's like opportunity cost. We have learned this in macro. In an economic class, right? It's, the return we require on this asset is our opportunity cost. Which is opportunity cost? It is the return we're gonna get from a comparable project or comparable asset, okay, of a similar risk. They have to be similar risk. So remember in chapter 7, right, we have comparable company methods to value a stock. So it's like if we wanted to get a required return on this stock, we find its competitors or other company doing similar business. They are considered of having similar risk, right? And see what the other stocks offer you, and require similar return on this specific stock. Okay. Then how to measure risk? So risk is what? The risk is the volatility or the uncertainty of the price. The price can go up and go down, and that uncertainty is captured by our risk measures. Okay, so there are two measures we use: variance and standard deviation. These are basically math stuff. Variance is just the average value of a standard deviation, squared deviation from the mean. Okay, we're gonna do calculations on that, and standard deviation is just square root of variance, okay? And the mean is just the expected return. Okay, expected return is probability weighted average possible outcomes. Okay, let's see some examples. Okay, the variance of an investment return is a measure of the volatility of a rate of return, the probability of a negative return, the historical rate of return over long periods, and the average value of the investment. It's 8, right? And the volatility of the rates of return. Okay. Good. Which one of the following security classes has the highest standard deviation of returns? All right, so must be common stocks, right? Bonds. So let's give them an order. Which one has the lowest, standard deviation? So which one? Bills, right? This is the lowest, and then a long term, and then the corporate, right? Corporate bond, and then corporate stocks, right? So it's in terms of variance and standard deviation. So corporate bonds, we are assuming they are similar corporate, right? They have to be similar corporate. Okay, let's do some math. So a stock is expected to turn 11% in normal economy, 19% if the economy booms, and lose 8% if the economy moves into a recessionary period. And economists predict 65% probability of normal, 25% chance of boom, and 10% of a recession. So what is the expected return on this stock? So weighted average return weighted by probability, right? So okay, so how to do this? So the probability of being normal period, normal economy, 65 divided by 11, right? 11% plus chance of a boom, 25 multiplied by 19 plus probability of a recession multiplied by losing 8%, right? Negative 8%. So what's the answer? I'm not going to calculate it. That's 8, right? The calculation, that's 8. So over the past three years, on the investment return, there's 3 numbers. What is the variance of the returns? So to find the variance, we need to first find the mean, the expected return. Expected return is just the weighted average return weighted by the probability. But these 3 are the return from the 3 years, so they have same like probability. Each of them happen only once, 1/3 of the total total number of the observations. So it's easy to find the expected return. Expected return is something divided by 3, 18 plus minus 12 plus 15, 6, 21, 7%, right? 7% expected return. And then the variance. Variance is something similar, so something divided by 3. And the squared deviation of our returns relative to the mean, right? So it's 18 minus 0.07 squared plus minus 12 plus, minus, right? Minus 0.7 squared plus 15 minus 0.07 squared, right? Just that, right? Okay, and the answer should be, if I remember, it's B, right? 182. And then if you want to get a standard deviation, it's just a square root of 182, right? Okay, it's simple. Just do a calculation. I'll do this carefully, slower and carefully, and make sure you got the number correct. Okay, all right. Question? Yeah.
What is the variance? You use the percentage minus the 0.07?
That's the definition. There's no, this is the definition of math. These are an absolute number. These are not percentage. And each percentage, each outcome, minus the mean or the expected return, that's the deviation, right? And you square it. And you square it, sum them up, divided by 3. Why do we need to square it? Because positive number and the negative number can cancel out. And you lose your like ability to capture that deviation. So you make it the squared and make it all positive, add them up, and measure the total deviation, right? Okay. Let me erase it, okay? Yeah. Answer B. What's standard deviation of a portfolio returned out to produce returns of this? So similar, right? Similar. I'm not going to do the calculation exactly the same. Take the weighted average, take the mean expected, take the mean return, which is expected return, and calculate the variance, and then take square root to get standard deviation. Right. Answer A. So okay, a stock has an expected return of 15%, and stock B has an expected return of 8%. What is the expected return on the portfolio? Which is comprised of 60% of stock A and 40% of stock B. So the portfolio return is just the weighted average return of all the assets in the portfolio weighted by their proportion or the weight, right? So the expected return of the portfolio is just 60% of their weight on asset A or stock A, multiplied by the stock A's return plus the weight on stock B multiplied by stock B's return, 8%. Okay, just that. So the answer is A. All right. Okay. All right, let's move on. So the market portfolio is made up of individual stocks. So why isn't its variance or variability equal to the average variability of components? Okay? The answer is that diversification reduces variability. Okay, that's the function of diversification. Diversification allows us to reduce risk by spreading the portfolio across different investments. Okay. There are a very good example in a textbook, illustrative. So there are two types of asset. One is an auto company, share of auto company. The other is gold. Auto company performs very good during good time, but very bad during bad time. But gold performs very good during bad time, but very bad during booming, like good time, right? So their return, like they are negatively correlated with each other. And if you do the math and see there's changes in the standard deviation and their return, if you change their weight, each of their weight in the portfolio, you're gonna see a very powerful effect of diversification. The standard deviation or the volatility reduce significantly, but the return only just drop a little bit. So that's the benefit of the standard deviation. If you are interested in that, you can read that example. So portfolio diversification works because price of different assets or stocks do not move exactly together. As long as, so the statement could be, the precise statement is, as long as the assets in your portfolio is not perfectly correlated, like they exactly move together. As long as they don't move exactly together, there are gonna be some benefit of diversification. The benefit of diversification is more when the correlation among different assets is lower, or hopefully negative. Okay, so that's the statement. So diversification works best when the returns are negatively correlated. When one business does well, the other does badly. Unfortunately, in practice, stocks that negatively correlated are as rare as a summer snowstorm. Okay, right? Because each asset are more or less related to the macroeconomic, right? There are some business that sometimes they're doing well during a recession, say movie tickets, right? So people lose their job, but they still go to cinema and watch movies. So that those entertainment industry may perform a little strong during recessions, right? And some relatively cheap makeup, products got very profitable during recessions. But generally, all the assets, most of the assets, they move all together, and positively with macroeconomic, right? Okay, so I cut this picture from textbook. Say we have a stock or asset A and asset B. Okay, asset A has a standard deviation of this amount and expected return of this amount, this level, and stock B is right here. So if you change, and they are negatively correlated. Okay, their return are negative. They are not perfectly correlated. They are negatively correlated. And if you change your weight of your portfolio on stock A versus B, this is the path of a combination. Okay, and their combination of a standard deviation and return. So to some extent, if you change your weight to, I can't remember the exact number, but to change your weight from a complete A portfolio to some B and most A, so their standard deviation is going to reduce significantly, but you can see their return only drop a little bit. Okay, so that's the purpose, or that's the benefit of that diversification. So if A and B are exactly correlated, so the positively correlated with the correlation 1, so this investment opportunity frontier may look like this. Okay, in this case, there's no benefit of diversification. Change in standard deviation and return move proportionally. But as long as A and B, their returns are not exactly or perfectly correlated, there's gonna be some, this is return and return standard deviation combination, some benefit of standard deviation. As they are more negatively correlated, it's like this, okay? As they are more negatively correlated. So we move in there, we are reducing the standard deviation. but not sacrificing the return. So that's the benefit of benefit of diversification. Right? And we call this graph the investment portfolio frontier. Okay. All right. Okay. Yeah. One more thing is, okay, at the frontier, we should say an asset gave us this combination, standard deviation and return combination. We will only accept this asset when its return is above that, right? Above that. We will not accept that its return is below this, this frontier, right? Because it gives us a lower return with the same level of standard deviation, which doesn't make sense, right? We'll only accept assets above that, right? Let's move on. Which one of the following concerns is likely to be the most important to portfolio investors seeking diversification? Correlation, right? Correlation of returns between stocks. Okay, that's the single most important concerns. Okay. Right. Okay, these are 3 long paragraphs. Same thing from textbook. Let's read it together and see if we understand. So people care about the combination of risk and return. And the risk of the overall portfolio can be measured by the volatility of returns, which is variance and standard deviation, which we have already know how to calculate. And standard deviation of the return of an individual security measures how risky that security would be if held in isolation. But in reality, an investor who holds a portfolio of securities is interested only in how that security affects the risk of the entire portfolio. Okay. So same thing, if you want to understand this, read the auto company and gold book, the example. Each of these 2 stocks are very risky. They're high standard deviation. But we don't give or require return based on that single standard deviation. We require return based on their contribution to the portfolio. The portfolio risk, portfolio variance, right? The portfolio standard deviation. We look at their contribution into the portfolio. Okay. And we're gonna see how to measure that, which is a beta that we're gonna use in the chapter 12. Okay. So how each security affects the risk of the entire portfolio, and the contribution of a security to the risk of the portfolio depends on how the security returns correlate with the investor's other holdings. Okay, their correlation, and thus a security that's risky if held in isolation may nevertheless serve to reduce the variability of the portfolio if its return do not move in lockstep with the rest of the portfolio. Okay. And you can calculate how risky a portfolio has been by collecting its historical returns and calculating the standard deviation or variance. And the reduction in portfolio risk from the diversification depends on the correlation between stock and the portfolio. Okay. So the example could be, say we have an asset A here and a portfolio in here. Portfolio also gives us a standard deviation and a return, right? And how the asset A contributes to our portfolio is along this path. Okay, if we know the correlation between A and F. So and if in the portfolio, and if a return of A is weakly correlated or even negatively correlated, we're gonna see this path. By adding A into our portfolio, we are able to reduce our standard deviation while not sacrificing risk, but sometimes even increasing, not sacrificing return, but sometimes even increasing return. So that's the contribution of asset A to our portfolio. And we should give a return, require return based on this contribution instead of the asset A's standard deviation in isolation. Okay. So portfolio of stocks all taken from one industry, for example, would not benefit much because the return would be highly positively correlated. And a portfolio diversified across different industries would benefit more, okay, since their correlations are relatively lower. Okay. Right. And then let's differentiate market risk and the specific risk. Okay. Only the contribution of the variability or the risk contribution of one specific asset to the portfolio should be counted. Okay, but what do we call that? We call that specific risk and market risk. Okay, what are these? So specific risk is the risk that's peculiar to this firm and not related to the economy or other companies, other firms. So for example, you are like a gold mining company, and you are looking forward to see expanding your business, and you are like going into a gold mine hoping there are going to be a lot of gold in there. But there's a risk until you have finished all the projects and dig deep into there and see if there's gold in there. It's pretty uncertain. But that uncertainty is only peculiar to your specific to your own company. It's not related to other companies or the whole economy. So that risk of finding gold in there or not should not be priced, and they are called specific. When you are forming a portfolio, when you are and determine the risk you return from this portfolio or this specific stock, you should not consider this uncertainty or this risk of finding a gold mine, or let's say a risk that is uncorrelated or unrelated with other companies or the economy. Okay. And the reason we should ignore that specific risk is that we can diversify it away by holding a large number of different stocks. We can diversify that risk away. So that risk is what? We should not price that risk. We should not require return on that risk, because as a rational investor, we can more than able to diversify that risk away and keep our original return, right? So that risk is totally unnecessary. We should not price that. But market risk is some risk that we cannot diversify away. It's always there. So as we take one more unit of market risk, we should require one more unit of return. Okay, we should require return on market risk, which are the risks that we cannot diversify away. And these are the risks that correlate with the macroeconomic. Okay, this specific stock's correlation with the macroeconomic. That cannot be diversified. So this is like the risk of our portfolio as we increase the total number of assets or stocks. Okay, as we keep increasing our different number of stocks, our risk goes down. But it reaches some point. At the extreme, in the very end, we are holding the market portfolio. We are holding each single asset on the market. And we all know market has some risk, right? If we look at the S&P 500 or the overall market, they are not riskless. There are still some risk in there. And that is the market risk, the risk that left. And the risk that has been eliminated are specific risk or diversifiable risk. We just eliminate those risks without sacrificing our return. Okay, so those specific risks should not be priced. So risks that are peculiar to a single firm, C, right? Specific stocks. And the major benefit of diversification is increasing expected return, removal of negative assets from the portfolio, reduction in the market risk. D, right? Reduction in the total risk. And which part of the total risk is specific risk, right? Diversifiable risk. Which one of the following risks can be progressively eliminated by adding stocks to a portfolio? Specific risk. So B. 20, right? So let's go a little faster. These are conceptual questions. Which one of the following risks is most important to a well-diversified investor in common stocks? It's most important. So market risk or systematic risk. Okay. Right. Right. So risk that can be eliminated by diversification is called specific risk. The risk that you cannot avoid regardless how much you diversify is generally known as market risk or systematic risk. Specific risk arises because many of the perils that surround an individual company are peculiar to that company and perhaps its direct competitors. Okay? But market risks stem from economy-wide perils that threaten all businesses. Okay? All businesses. And market risk explains why stocks have a tendency to move together. So even well-diversified portfolios are exposed to market movements. Okay, so since most of stocks on the market are moving together, so when we are holding a portfolio, most of the time we are having a portfolio that moves positively with the market. So that we say, and we call that some positive market risk loading, right? Market risk taking. And we can also have, say, a riskless portfolio, like just holding one treasury bill. In that case, okay, that's riskless. If it's riskless, we should not require any return on that. Okay, we should not just we price market return based on the extent or the level of market return we take. Okay, so our return should be proportional to the market risk that we are taking. So if we are not taking market risk, we should not require any return. Okay, or just we should just require be more precise, a risk-free return, right? So investors hold diversified portfolio are mostly concerned with macroeconomic risks. They not worry about micro risks peculiar to a particular company or the project. Micro risks wash out in diversified portfolios, and company managers may worry about both macro and micro, but only the former affect the cost of capital. Okay, as investors, we care about macro risk only, but as managers of company, they want to what? They want to beat people's expectation. They want to be, they want to perform above and beyond the expectation, since this is related to their compensation, to their salary, right? So they care about the risk of finding this gold mine or not. But as investors, we're holding a well-diversified portfolio. We do not care about that. But we are happy to see this company perform better than what we require, like expected, right? Then that we are happy. Companies that are exposed to business cycle tend to have high market risk, okay, positive to market risk, 16. And expected return on the security includes a reward for market risk and specific risk. We do not get a reward for specific risk, right? Time value of money, okay, the cost of waiting, and the market risk, the cost of worrying about the return. Okay, but there is no space for the specific risk. Okay, all right. Macro events only are affected in the performance of the market portfolio because contains only risk-free securities? No. Only macro events are tracked by economists? No. Specific have been diversified away, right? And firm-specific events would be too numerous to no, it's not D, so the answer is C, diversified away. All right, that's chapter 11, right? If you have any question, you can. So Oliver has to leave after the session, but we still have time. If you want to stay and ask me questions, we can have a discussion. But let's move forward. We have finished within 2 hours. It seems we have plenty of time. So market portfolio. So we have said that a portfolio for all assets in the economy. So this chapter we continue discussion of the risk and return and introduce how to find a required rate of return or expected rate of return for a single stock, and using a very famous model, CAPM model. And let's see how to apply that model to find the return we need, okay, and quantify the market risk that we just talked about. So market portfolio is a portfolio of all assets in the economy. In practice, abroad, so it's very hard to find, right? It's all assets in the whole world is hard to find. But in reality, we can find some proxy representative portfolio. In practice, a broad stock market index is used to represent the market. Okay, so let's be SP 500, right? And how to quantify the market risk that we talked about? We use beta. Okay, what is beta? It is the sensitivity of a stock's return to the return on the market portfolio. Okay, so that measures the correlation between this specific asset with the market. Okay, or it measures the intensity or the level of a market risk that the specific stock is taking. Okay, if so, quantitatively, mathematically, beta is what? Is the percentage change in the return of this stock when the market return change by 1%. Okay, so let's say if the market return increases by 1%, and this stock gives, as a stock return increases by 2%. So the beta of this specific stock is 2 divided by 1, it's 2, right? So in other words, this stock is very sensitive to market return, or this specific stock fluctuate more with market return. So if that is true, we say this stock is an aggressive stock, or this stock has beta higher than 1. So for each percentage change of market return, how much percentage change in this stock return gives you, okay? So it's like what? So it's a percentage change in return. So let's say market return change from RM1 to RM2, and with that, stock I's return change from RI1 to RI2. So that is the definition of beta for stock I, right? So that's the definition mathematically. So for each percentage change in market return, how much percentage does this stock return change? Okay, right. Okay. So if the beta of this stock is higher than 1, we say it has a higher market risk. We call that aggressive stocks. If the lower than 1, defensive stocks. Okay, so a stock with a beta greater than 1 would be termed as an aggressive stock, either A or C, tends to increase more than the market increases, right? Not decrease. It increases more. So if decrease more than the market increases, it is a negative beta, right? It's a negative beta stock because when the market goes up, it goes down, right? So negative beta. And if it decreases more, it means that it's a very negative beta, right? So it's more than defensive, right? It's like a reverse of the trend. So, but the answer is A, aggressive stock. Okay. So we can break down common stock returns into 2 parts. The part explained by market return, which is measured by a firm's beta, and the other part is due to news that's specific to the firm, which is specific, the return that require for this specific firm, okay, it doesn't exist. We don't require that, okay. Fluctuations in the first part reflect market risk. Fluctuations in the second part reflect specific risk, okay. And if we hold a well-diversified portfolio, we should only care about this beta, okay, and use this beta to find the return that we require on this stock. Okay, let's see how to find that. Okay, let's move on. So a stock's total risk depends on the stock's beta and market. Beta. So total risk depends on beta and the specific risk, the total return, right? The specific can be diversified away, right? Yeah. Okay. So this is like in empirical. How we find the beta. All these dots are historical observations on the market return and like a return of Edison, okay? So each of these dots is a trading day, okay? Say on that day, market return gives you around 10%, but the Edison stocks gives you -6%, okay? And these scatter plot gives you like a general impression of how the stocks return move with the market return. And we will find a fitted line that best describes this relationship. Okay, that line is like generally Edison return increases with the market return. Okay, and the beta of that stock is just a slope of this fitted line. That's the fitted line. Okay, the slope of that. Okay, like it's how much does this stock specific return change with 1 unit change in the market return. Okay, that's the definition of beta. Let's make it more. Say beta is like this, the fitted line like this. So the slope of that line is the beta. Okay, like the sensitivity of this specific stock return to the market return. Right. if a stock consistently goes down by 1.6% when the market portfolio goes down by 1.2%, then the beta equals, so it's negative 1.6% divided by negative 1.2%, right? So let's see, right? So if we have a portfolio, and we know the beta of each asset in the portfolio, how to find the portfolio beta? It is exactly the same as finding the portfolio expected return. We take the average beta of all the assets in the portfolio, weighted by their weight or their proportion in the portfolio. Okay, exactly the same as calculating expected return. So see if we have an example. All right, okay, so the beta of a 3-stock portfolio includes 25% of A with a beta of that, and 40% of B, 35% of C. So the portfolio beta should just be 25% multiplied by 0.9 plus 40%, 1.05, 35%, 1.73. Right, so that's the portfolio beta. The answer is D. Okay. Now let's see how we use beta to find the return that we require on this stock. Like a beta represents the market risk that we are taking on this stock, and we use CAPM model to find the return we require. Okay. So CAPM has a simple interpretation. The expected rates of return demanded by the investors depend on two things: the compensation for the time value of money, so that's riskless return, like a risk-free return. And then, like the risk premium we add on top of that. So what risk premium? So this is so the RA is a return total return we require on this stock, and the RAF is a risk-free return. That's part A, and the other part is part B, the risk premium on top of a risk-free rate or risk-free return. So it is beta multiplied by RM is market return. Okay, market return. So RM minus RF is the expected market risk premium. Okay. So if anybody talks about market risk premium, it is RM minus RF. But what is the risk premium for this stock? It is beta multiplied by market risk premium. Okay. So market risk premium is like the risk premium you require. No, not micro. This is Finance 3000. Yeah. So market risk premium is a premium you add on top of risk-free rate for holding the whole market, right? And the risk premium for this stock is the premium you add on top of risk-free rate for this specific stock. And how to measure that? We multiply beta by the market risk premium. So the risk premium on an asset is the beta multiplied by expected market risk premium. Right. So that we can also find a definition of beta from here. Right? Beta is just what? Is just R minus RF divided by M minus RF. Okay. So that is beta, right? We move RF to the left-hand side and move RM minus RF to the denominator. So that's so that is beta. Okay. So what is the standard deviation of the market portfolio if the standard deviation of a well-diversified portfolio with a beta of 1.25 equals 20%? Okay. So this market. So here is the definition. The standard deviation of a portfolio is proportional to the beta. Okay. So if beta, let's see this beta of the portfolio and beta of the market, which is always 1, right? Beta of the market is always 1. Right? I forgot this. So if R is a market portfolio, then the two things are the same, right? If R is a market portfolio, then it's RM, right? So if it's RM, how much is beta? Must be 1, right? So the beta of the market portfolio is always 1. So okay. So RM, if we are holding a market portfolio, we naturally require an RM on this portfolio, right? So the beta for this market portfolio is just RM minus RF divided by RM minus RF, which is 1. Okay. So the risk premium for the market is RM minus RF. Okay. Okay. And then, so the beta is proportional to the standard deviation. So if the portfolio gives you standard deviation of 20%, let's say 0.2, so what is the market standard deviation? If that beta is 1.25, so let's say x is 0.2 divided by 1.25, right? So market beta is 1, portfolio beta 125, portfolio standard deviation 0.2, and the portfolio and the market standard deviation, which be A. Okay, 0.16. Okay, a project has a beta of 1.25. Okay, risk-free rate of 3.8. 1.24, 3.8. The market rate of return is 9.2%. What is the expected rate of return? Just plug in the number to the CAPM, RM minus RF. Okay. So the beta is 1.24. The risk-free rate is 0.038, right? And 0.038. Okay. And market rate of return is 0.2, right? So plug in the number. So just be careful when you're reading the question. Is market rate of return is not market risk premium. Okay, if it's market risk premium, we are talking about this whole thing. But market rate of return is just that. Okay. Let's see. The market rate of return is 12.5%. Risk-free rate is what will be the change in a stock's expected return if its beta increases from 1.2 to 1.4. It's simple, right? We calculate two expected returns. The first one is with beta 1.2, the second 1.4. So what would be the change? So the return 1, let's say when the beta is 1.2 is 0.1 plus 1.2 multiplied by 0.125 minus 1, right? So that's the first required rate of return. And the second is same thing, but just to change the beta to 1.4, right? And R2 minus R1, right? That's the only change. Okay, the change in the expected return is just R2 minus R1. Okay. calculate the risk premium on stock C, giving the following information: risk-free rate of 5%, market return, and beta. Okay. So what is the risk premium? Risk premium is not a required rate of return anymore, right? Risk premium on stock C. So by definition, risk premium is the actual risk we require on this stock on top of a risk-free rate. So that is beta multiplied by Rm minus Rf. Okay. So that's the risk. So that's the risk premium on this stock. So risk-free rate is 0.05, 0.13 market, and 1.3 beta. Okay. So that's just a part of the CAPM. So that equals what? R minus RF, right? So the return we require on top of RF is that part. So that's the risk premium, right? Okay. I'll leave it here. So you believe that alpha stock, which has a beta 1.32, will give a return 16% this coming year. You believe 16 return will be the return that you're going to earn next year. And the market is expected to return 11.4%, and T-bills return 3.8%. T-bills riskless rate, right? Risk-free rate, treasury bill. And according to CAPM, which one of these statements are correct given this information? Let's see what rate of return we should be requiring from this stock. Market, so CAPM, yes. So risk-free rate, 0.038, right, plus, and the beta is 1.32, and market, 0.114 minus 38, okay? So that is how much? .14 minus 0.038, right? And multiplied by 1.32 plus 0.038. Okay, right? Is it right? Am I doing correct? 0.14 or 0.114? 0.1114, right? Yeah. Otherwise, we cannot get A. And looking at the answer, it's not correct. Okay, multiplied by 1.32 plus 0.038. Right. So that's the right answer, right? So that's the return we require. But this stock actually next year we believe it give us 16%. So investors should only require 14%, but that stock gives us 16%. That is saying this stock is currently underpriced. It's currently underpriced, right? So that next year it gives a higher return. Okay. Answer A. Underpriced. Right. Okay. So a portfolio consists of an index mutual fund, which represents the overall market, and the treasury bills. The fund has a portfolio with 60%. Okay. And so 40% is on treasury bills. Okay. And risk-free is 3.2, and market risk premium is 7.6. What is your best estimate of the portfolio expected rate of return? So first, the portfolio expected return, to get that, we have to get the return on each asset we hold. We already know the risk-free rate. Okay, the rate for the treasury bills. What about the mutual fund? It is 3.2 plus, so R on the same mutual fund. 3.2 plus the risk premium. Sorry. 0.32 plus the risk premium. Right? Correct? So the return on this mutual fund is a risk-free plus market risk premium. Okay. And we are assuming this mutual fund represents the overall market, gives a beta of 1. So 1 multiplied by market risk premium. Okay. And then, so the weighted average return is just 60% multiplied by 0.108 plus 0.4, 40% on the risk-free rate. Okay. Mutual fund. So it's what? It's risk-free. Our mutual fund is a beta of this mutual fund minus RM, multiplied by RM minus RF. This is 0.076, and this is 1. Why is that 1? Assume it represents the overall market, and our RF is 0.03832. Okay, so that's the return on mutual fund, and take a weighted average. So that is the portfolio return, RP. Is that okay? All right. So if we have, now we have CAPM and we have a required return for each asset, if we know its beta, then we can plot a line, draw a line that describes the relationship between expected return of a stock or asset with its beta. And we call that graph security market line, right? Where is security market line, where is that? But that's the name of it, I can't find it. Okay. I cut all these pictures from textbook. So say for market portfolio, it has a beta of 1 and give us like a return of 10%. And the 10% minus the risk-free rate 3%, the difference is 7%. It is a market risk premium. Okay? And that's market portfolio. But we can also take other portfolios with different betas. Okay? The lower beta we take, the lower return we should require. Okay? Say for portfolio X, we give it a 0.5 beta. Okay, only take 0.5 beta. So proportionally, we get a return of 6.5%. And the risk premium for this portfolio is the difference between 6.5 minus 3. Okay. So that's the risk premium for this stock. Okay. So also throughout the line, along the line, we can find any combination, okay, of beta and the corresponding return that we should expect. Okay. Another thing is the slope of that security market line has some meaning. What is the slope of that? What do we call that? Let's say that line is like what? R equals to RF plus beta multiply RM minus RF. So this line describes the relationship between R and beta. So the slope of that line should just be the market risk premium, right? The slope of it. Right? That's right. So the slope of the security market line should just be the market risk premium. Okay. So if a security plots below the security market line, it is what? So we are taking this beta. But this stock gives us a return that's lower than what we expect, right? Offering too little return to justify its stock, its risk. The slope of the security market line is the market risk premium, RM minus RF. Right. Okay. So how to use, the question is now how to use the beta. We can find those. This is the last part of chapter 12. So this talks about project beta and company beta. So the main takeaway is when we are pricing a project, we should use like a company takes different projects or multiple projects, and we are valuing this value. We are giving a value to this project. We should discount its expected cash flow by the cost of capital, right? Opportunity cost of capital, and the opportunity cost of capital is the required rate of return. So how to find the required rate of return? We should get its beta. So the main takeaway is if we are valuing a project, we should use a project beta instead of the company beta, since the project market risk could be very different than the company level market risk. But in reality, it could be very hard to find the project beta, right? That single project could be very specific and unique. It's hard to get their historical data to find that beta. So let's make an assumption. So a company beta, a company cost of capital could be acceptable if this project gives a risk that is similar to the overall risk of the company, right? Like this project represents the average market risk of this company. If this is true, we can use a company beta instead of the project beta as an approximate, right, estimation. Okay. So the project cost of capital is just minimal acceptable rate of return on a project given its risk. Okay. So if the CAPM holds, okay, many people believe it doesn't hold very well now, right? So that's the most simplified model that describes the stock market. Now the asset pricing model is much more complicated than the CAPM, but that's where we started, right? Like 60 years ago. The security market line defines the opportunity cost of capital. Okay, opportunity cost of capital is required rate of return, which is get from the beta, right? If a project expected rate of return plots above the security market line, it then offers a higher return, offers a higher expected return than investors could get on their own on the same beta. So that means, in reality, if we take some beta like here, this is the level of a return that we should be able to get, or we should expect. But if the project gives a return higher than that, that means that's a good project, right? That gives a higher return than what investors could get on other projects with similar risk. Okay, about that. Then it offers higher expected return than investors could get on their own at the same beta. And what is the company cost of capital? It is opportunity cost of capital for investment in the firm as a whole. It's not a single project, it's a firm as a whole. And the company cost of capital is appropriate discount rate for an average risk investment project undertaken by the firm. Okay. Therefore, most firms estimate the company cost of capital, which depends on the average of its investments. Okay. Let me see. Another thing I need to add is when we are there's one mistake financial analysts or financial managers may make when they are projecting their future cash flows. Say the example that we just said, we don't know if we can find a gold mine when we start the project. sometimes they may put this specific uncertainty into the required rate of return. Say the probability of finding probability of not finding anything, okay, is 50%, and find something is 50%. This uncertainty, some financial managers may put that uncertainty into cost of capital because they are uncertainty, but it is wrong. To put that uncertainty into the whole model, they should put that into the numerator. Say, this gives us an expected rate of return, or expected return 0.5. So that is the expected cash flow that we should use, right? Not 1. Like, what if we have 1? So we should use 0.5 and discount 0.5 by some R, which can be found using security market line. Okay. So those specific risks should already be considered when they are calculating cash flow. Okay. Expected future cash flow. And then, okay, let's do the other questions. The minimum acceptable expected rate of return on a project is project cost of capital, right? That's A. A project with higher than average risk offers an expected return of 14%. Okay. Higher than average company level risk, which statement is correct if the company opportunity cost of capital is 12% and the project's cost of capital is 15%. Okay, so the project cost of capital for 15%, and the project gives a 14%. So it's lower than the required rate, right? So that project NPV should be negative and should be rejected. Okay. In this case, we know the project opportunity cash flow, so we should compare 15% with the project's expected return. Right? It's lower than that. Negative net present value, right? That means if we discount the future cash flows by the required rate of return, okay, we should get a negative present value on this project. Okay, there are some capital outlay at the very beginning. We make some investment negative cash flow, and in the subsequent period we got some positive cash flow, and we discount everything, add them together into a present value. This number should be a negative number. Okay, which means it doesn't make sense, right, to do this project. Which statements are correct concerning macro risk exposure? A, now clear, not A, not B. Macro risk exposure affects capital, cost of capital, right? That's correct. It's less important to diversify investor than micro risk. It's more important, right? It's more important than micro. Okay. The idea that an investor on average have earned a higher return from common stocks than from treasury bills supports the view that they're not irrational. It's a relationship between risk and the return, right? Real return should be lower and return should be avoided. No. So the answer B. Okay. There is a relation between risk. If we take higher risk, we require higher return. And for common stock, we require risk premium. And that's the actual return we require. And the appropriate opportunity cost of capital is the return that the investor gave up on alternative investment that with similar level of risk, right? Possess the same level of risk. Not all the others, right? Not free rate, not market risk, not market return, not average market rate return. Okay. An estimation of the opportunity cost of capital for projects that give an average level of risk is the expected rate of return on. So average means here is like with the market, like comparable with the market level. Okay, so should be the risk-free rate plus some, like if it's market risk premium, then should be the market portfolio is the comparable asset or portfolio, right? Okay. what is the typical relationship between the standard deviation of an individual common stock and the standard deviation of a diversified portfolio of common stocks? The individual stocks should be higher or lower. So okay, so what does this imply? It implies this stock is a part of the, so if this stock is a part of the diversified portfolio, then that is true. The standard deviation of this single stock should be higher than the portfolio, right? This is not a very good question. So if the standard deviation, if this stock is not related to the portfolio at all, then there should not be any relationship, right? So if the stock is a part of the portfolio, then the standard deviation should be higher than the diversified, should be higher than the standard deviation diversified portfolio. Okay. Now, typical. I know this is not a good question, right? There are many too blurry. This is blurry description. The standard deviation of individual stocks are generally higher than the standard deviation of the market portfolio because market portfolio offers diversifies risk, right? Okay. And the interests are generally perform very well when the entire economy perform well, and perform very bad when the economy perform bad are called cyclical, right? It moves together with the economy. Okay. And the reverse is called counter-cyclical, right? Cyclical industries. The incremental risk to a portfolio from adding another stock may be positive or negative depending on the correlation between the stock and the portfolio. Okay. Let's say security, the investment opportunity frontier. If this is the portfolio we have, and if this is the stock, and if they are, let's say, to the extreme, like perfectly correlated, then when we are moving to holding more stock, then the standard deviation could be higher, right? There could be higher standard deviation, higher risk. So that's all the questions on this question list. But we still have time. So Oliver, do you want to? So that's the whole part of my review. Now I want to do some just a Q&A. I will bring up my previous slides and let students ask questions. And you can stop here, or if you want to continue, we can continue. So okay. So I don't have a specific topic to talk about now because I know if we start, it's gonna be a long session. But let me get my previous slides. You can ask me any questions that you have. Not from here. So I think second part is harder, right? So second, so chapter 5 and 6 is a little harder than the first one. So let's do. How about we start from second? So review question list slides. That one, yeah. Okay. I can quickly go over this, and you can interrupt me, and let's talk about the questions if you have. So So bond and stocks. Okay, the chapter 6 and 7. Okay, let's quickly do this. Just briefly recall what we know about bond and stock. So bond is a fixed income security. It has a limit, a finite maturity, like a life. And it gives us a periodic coupon in each period, usually half year or a whole year. And a fixed principal payment at the very end when the bond matures, right? But the stock, it doesn't have a maturity. Ideally, it has an infinite life, and it doesn't have like periodic payments. Okay, it gives a coupon, but it's not certain. Sometimes the company will give, but sometimes they may not give. So we use different like discounting or pricing methods to do the pricing, right? For bonds, bonds is literally an annuity, a series, like a stream annuity, followed by a finite, like the final principal payment. Okay, but there are also like bonds with infinite life. Say some if I remember correctly, some British government bond, they have infinite life. So that could be we can use a perpetuity pricing model, right? Just to divide the periodic payment by the required rate of return to get this price. And for stocks, we make assumptions. So stock price is just the present value of all future dividend payments, right? We can use the dividend and like a terminal price, but terminal price is also determined by either further future dividends, right? So the current stock price should be the present value of all future dividend. And we can make assumptions on the dividend and then use our different pricing model. If we assume the dividends are constant, we can just assume it's perpetuity, right? Divide the dividend by the required rate of return. Or if we assume the stock dividend increases at a constant rate, we can use constant growth rate model. If you remember, that is RP. So that's the next dividend. The next dividend 1 period from now minus the required rate of return. Minus the growth rate, right? It's like the growth rate. So, let's do some questions. So that's what D1 is 1 period from now. It's not the current, right? It's not the one that just paid right now. It's 1 period later. So, what others? And the efficient market hypothesis. There may be conceptual questions on that. Most stock markets in developed countries are efficient, meaning that there are many people, many investors, financial analysts following all the stocks on market, so that it's very hard to find an arbitrage or profitable opportunity. It's very hard to beat the market. It's very hard to get a return higher than what an average investor can earn from the market. If the stock market is very efficient, we call the stock price follows a random walk. Like we cannot predict the future price movement based on historical price patterns, right? That means the technical analysis is not useful, right? But there are different forms of efficient market. It could be strong form, semi-strong, and weak, right? There could be in some market could not be that efficient, right? In developing countries, some stock markets are not that efficient. That means for some investors, still they are able to beat the market and earn excess return. Okay, I can't remember everything now, but let's do some questions and see if we can recall some other things. What happened to, okay, let me see. How about this? We don't do calculation. We just quickly go over things. And if you want to do a calculation, interrupt me. Okay, you have about 40 minutes. What happened to a coupon rate? Okay, coupon rate is fixed. Don't need to read the rest of the question. Coupon rate is fixed at the introduction of the bond, right? It remains. It pays 80%, so the coupon rate is 8%. So it stays at 8%. Okay. Interest risk is just the risk of bond price change in response to interest rate change. Okay, so let's say in this question, interest change from 8% to 6%. It goes down, right? So the price of the bond should go up. And if you calculate a 3-year bond, fixed value 1,000, and interest rate change from 8 to 6, and 8% annual coupon, they are fixed. Yes? Okay, yeah, sure, sorry. Okay. So the only change is the interest rate. So if the interest goes down, we can see the market price, the bond price goes up. Okay. Do I have that graph? Remember we have this graph. So this is a relationship between interest rate and bond price. Bond price goes down when interest rate goes up because fixed income, they are fixed income. The future cash flows are fixed. But if you are a higher discount rate, the present value should go down. Okay. But the sensitivity of bond price to interest rate is different for different bonds. So the green line is a bond with a 30-year maturity. And so the blue one is with 30-year maturity. The green one is 3-year maturity. All other things are the same, which is 30-year bond is more sensitive to interest rate. That is because they have more cash flows that happen far in the future. And those cash flows are more sensitive to interest rate because they are discounted by more times, right, to a present value. But 3-year bond, they have the cash flows are relatively near to the present time, so they are less sensitive. What about others? Say 2 bonds, if they have say similar, not same, 2 bonds if they have same maturity, everything the same, but just a different coupon rate. Let's say one bond has an 8% coupon rate, the other has 6% coupon rate. Which one is more sensitive to interest rate? Or which one has more interest rate risk? It should be the one with a lower coupon. With a lower coupon, that means for this bond, it has a higher portion of cash flow happening in the far future, which is that principal payment, right? So if 2 bonds, everything the same. The only difference is the coupon rate. That means for the higher coupon rate bond, they have relatively higher portion of cash flow happen in the near future, right? Like $80, relative that are 1,000 at maturity, right? $80, they have relatively more. But for the lower coupon bond, they have like a higher portion of cash flow happen in the future. So the lower coupon bond should have a higher risk, interest risk, right? They are more sensitive to the interest rate. To the extreme case is it is like 30-year plain vanilla bond with 30-year zero coupon bond. Which one should be more sensitive to interest rate? It must be the zero coupon bond, right? Because it only has one single payment at maturity. Yeah. Okay. This question is pretty simple, right? This the bond interest rate is 6% and market interest rate is 5%. So the bond currently pays how much coupon? 6% is 60, and the coupon rate is higher than the market rate, right? If a bond offers a coupon rate higher than the market rate, it should be selling at premium, right? If the coupon rate lower than the market, it should be selling at discount. Okay. All right. This is what we just said. A change in interest rate only has a modest impact on the present value of near-term cash flows, but a much higher impact on the value of distant cash flows. Okay. Right. So therefore, any change has a greater impact on the price of long-term bonds than the price of shorter bonds. Okay. What is current yield? Annual coupon payment divided by the bond price. Okay, that's the current yield. Okay, that's the definition. What is a premium bond? A bond that is selling above the face value. If it's below face value, it's selling it's a discount bond. Okay. And this graph is important. So like if time goes on, from 30 years to maturity, like time goes in this direction. Okay, from 30 years to 0 to maturity, the bond price should move in this pattern. No matter it is a discount bond or a premium bond, their price should all move closer and toward the face value 1,000. Okay. What happened to a premium bond as time to maturity decreases? Its price gonna be decreasing, right? It'll be decreasing. Right. It's a B. So okay, yield to maturity. What is yield to maturity? It is the return that we're gonna get if we buy the bond right now and hold it to maturity. Okay, we have a purchasing price right now, and we have all these future cash flows and the terminal principal payments. So we can and we have say a number of periods, and we can calculate the R, right, using calculator, and that R, that IY, is the yield to maturity. Okay. Which of the following is correct concerning yield to maturity? It considers both interest income and price appreciation. That's right, right? And assume the bond is called. There is no consideration of call feature in yield to maturity. It's compounded rate of return. All interest rate reinvested. That's correct. All interest rate repayments at the reinvested at the YTM rate. Okay. How to understand the last term? It is what it is. So we are assuming compounding is possible in each period. Okay, that's the assumption that we make. That may not hold, right? But usually it holds, and that compounding can happen must be able to happen at yield to maturity. That means all the coupon payments that you receive before maturity can be reinvested at that rate of return to your investment. Okay. Okay, I need to adjust that for each slide. Okay, see. All right. Purchase a bond for this, and so this is the percentage rate of return, right? Okay, no, it's time. Okay, this is time. Okay, it's time value of money. All right. So this is the purchasing price, and receive annual payments at the end of each year for 5 years. When the bond redeemed at the face value 1,000, calculate the yield, the YTM, right? So the purchase price, periodic payments, and make sure this is annual interest rate. So it's a 5. So N is the number of periods, right? So if it's annual, it's a 5 multiplied by 1. 1 is a compounding frequency, so it's 5. And the future value, the terminal value. Okay, principal payment 1,000. So that this IY is the yield to maturity, right? Okay. What about that? Similar thing, right? We know all other variables and calculate PMT. Okay, similar. Assume a bond is currently selling at par, right? That means what? That means the market interest rate is is equal to the coupon rate, right? So it's par value 1,000. What will happen in the future if the yield on the bond is lower than the coupon rate? If the yield decreases, bond price increases, right? So if the bond price will increase, it will become a premium bond. And we know this already, right? We just saw that. So rate of return is the annual coupon plus this is not annual coupon, the coupon that we received during our holding period plus the price change, price appreciation or depreciation divided by our initial purchase price or investment. Okay, So if we hold that, say that investment for exactly 1 year, then the coupon is annual coupon, and P0 is the purchasing price. That becomes the current yield, right? And the second part is the capital gain. So that equation is basically rate of return consists two parts: the part from our current income plus the part from the capital gain. Okay. That applies to both bond and stock. Okay, so if it's a stock, this is annual dividend. A dividend by P0, and we call that dividend yield. Right? For coupon, we call that current yield. And then for stocks, these are the capital gain or capital loss. Right? So that applies to both bonds and stocks. What is the current yield of annual coupon bond with a 6% coupon, 4 years until maturity, and the price quote of that? Price quote of that means what? That means the price of the bond is now 84% of its face value. So it's $840. It's selling at $840 right now. So 60% coupon, so annual coupon 60 divided by the price. That's the current yield. Okay. So you buy this bond at this price, 3 year. Okay, so rate of return. Who pays that for 3-year bond with annual coupon of $65, and sells the bond a year later at this price. So a year later, so we get a coupon of that amount. Selling price minus purchasing price is the capital gain, right? Price appreciation or depreciation. In this case, depreciation divided by the purchase price. Okay. So you see, in this whole process, there's no time value of money, right? So that equation, that implies that equation can only be used for a holding period that is relatively short, usually 1 year or 2 years, in which the time value of money is not that important. But think about if this is 10 years. So if it's 10 years, we can't minus this amount from our selling price because they are different, right? They have very different value. But within short periods, they can be. That time value of money can be ignored. So question similar. We have different unknown variables here. Just to play around with that equation. Right? Okay, we can read that. Hopefully it's helpful, but let's see if we can understand. Is there any connection between the YTM and the rate of return during a particular period? This is from our book. So yes. If the bond YTM remains unchanged during the period, then the bond price change within time so that the YTM is equal to the total return. Okay. And the rate of return will be less than the YTM if interest rate rise. Okay. If the interest rate rise, the bond price will go down. That means there is some capital loss happening during our holding period. Okay. Right. So that means it should be and YTM is set when we purchase the bond, right? When we purchase the bond, the YTM it will be set, but the total holding period return are changing. If the interest rate increases, the holding period should be decreasing, right? Because same current income, but the price is going to be lower, so there are capital loss. So the holding period return should be lower than the YTM. Okay. If the interest rate fall, the total return will be higher than YTM. Okay. If the yield doesn't change, the return equals the yield to maturity. Let's see. So this relationship, I suggest you review this. There could be many questions in this part. For premium bond, rate of return, and if we assume the interest rate doesn't change, right? Rate of return is equal to YTM, and it's lower than the current yield and lower than the coupon rate. Okay. All right. So these two are easy, right? If it's a premium bond, the price is higher than the face value. So these two, their numerators are the same. but current yield, they have a higher denominator. Denominator is bond price. But this is not denominator. Let's say, okay, the coupon, let's say coupon is C divided by the price. This is C divided by 1,000. And price is higher than 1,000 for premium bond. So this whole thing should be lower than that, right? C are the same. The numerator has a coupon. Okay. But for YTM and the current yield, remember, YTM consider two parts. First part is the current yield, the return from the periodic payment. The second is the price change. Current yield is the first part. It ignores the price change part. For the premium bond, its price changing its change is going down, right? When it matures, it moves closer to maturity. So there is a negative capital gain. So that part is that implies what? That implies YTM, which consider both yield, current yield, and the price change, in total should give us a lower return for premium bond. But for discount bond, since its price increases when time goes on to maturity, it adds the current yield to some positive capital gain, which gives us a higher total yield than current yield. I'm not sure if this will be tested. Probably not. Hopefully not. But it doesn't harm to memorize that. Okay. All right. And then yield curve is a plot between bond yields to maturity, bonds yield to maturity and the time to maturity. Okay. So it's like if a cash flow happens in 23 years, what should be the discount rate for that? We draw this line using a strip bond, right? Strip bond. Bond that whose cash flow are split into single cash flows, each single cash flows, and each single cash flows independently forms one security. So for each cash flow, we can find the yield for that cash flow. And throughout different maturity, we can draw a line that like discount rate for cash flow that happen at each point of time. Okay, and usually it's upward sloping. Okay, and but during recessions or like volatile periods, depressions, it could be flat or even downward sloping. But upward sloping is the normal case. Okay. The yield curve depicts the current relationship between yield and maturity. See, right? Yield to maturity. If long-term bonds offer much higher bonds, why didn't everyone buy them? Okay. This is from textbook. The first reason is long-term bonds, their price are more sensitive to interest risk. So we require actual risk on that, actual return on that. And the short-term investor can profit if interest rise. That means if we have short-term investments, if it matures, and if there are higher return, we can buy a bond with higher return. But with a long-term bond, we can only hold it for 30 years, and we cannot adjust our return throughout our holding period, right? So it is a good idea for an investor to invest in short-term bonds when you are expecting a higher return in the future. Like if you expect 2 years later the interest will be higher, it's a good idea, a better idea to invest in a short-term bond right now, or treasury bill, treasury notes, and then when it matures, you can buy a new bond with higher return at that time. Okay, that formula we already know: nominal real rate, inflation, and default risk, and then credit rating. Remember that credit rating, that is the threshold of an investment grade bond, right? So investment grade bond is a BAA for Moody's and BBB for Standard & Poor's and above. Okay, below that they are junk bonds or high yield bonds. Okay. Default premium compensation is a compensation for a higher default risk for a low credit rating bond. Seniority, these are background, institutional background knowledge. So seniority, you can, when the borrowers or the debt issuers are paying off debt, they have like a sequence, they have an order. Those debt that are paid off first, they're senior than other debt. Okay, they're paid later, they're junior. So the seniority, the senior the bond is, the less risky, the less default risk it bears. And security is you put up a collateral when the borrower or the company is issuing bond, right? So it's, once the company defaults, they can give the collateral to the bondholder as a compensation. So those secured bonds are considered less risky than other bonds. Protected covenants, these are the covenants or the requirements that are put on the company, requiring them to to adhere to. Say your debt ratio cannot be higher than this ratio during the period of this bond, or your income has to be higher than several times of your total bond payments, bond holding, something like that, right? That makes sure that the company is running properly and running well. Okay, and other bonds that are not plain vanilla, what we talk about the plain vanilla bond, they have a fixed coupon periodically. There's no other features. There could be the zero coupon bond with no coupon at all. Floating rate bonds whose coupon rate fluctuate with the current interest rate. Okay, and convertible bonds are those bonds that can be converted into stocks. Just to give the right to the investor to convert the bond into stocks if they want. At some specific price. So as a bond investor, you may expect yourself to convert your bond to a stock when the stock price goes up, right? So it's profitable, make a profit. What would be the not considered by an investor by zero coupon bond? Zero coupon bond, there's no current payment, there's no current income, right? No coupon, so there's no current yield. There's no B. If the coupon rate on an outstanding bond is lower than the relevant current interest rate, then the yield to maturity should be, right? If the coupon rate is lower than the current interest rate, that means the bond is selling at discount, right? So if it's selling at a discount, we go back. So their yield to maturity should be higher than the current yield, right? And higher than the coupon rate. And here was the yield to maturity should be higher than the coupon rate and also higher than the current yield, right? Okay. 10% coupon bond and the current yield 7%. Okay, so in this case, current yield is higher than the coupon. They have the same numerator, but current yield is lower. That means it has a higher denominator. So the price is higher than 1,000, right? So P divided coupon. So this is coupon rate. This is the current yield. It has the same numerator. But this is lower, right? 7%. This is 10%. So that means price is higher than 1,000. Okay. So market value higher than face value. Okay. And about these. These are what? These are, so like if we hold the bond for 1 year, its price change by how much, right? Just your time value money function, and assuming there's no change in interest rate, 5%. And the coupon. All right. If an investor purchases a bond with its current yield higher than the coupon rate, all right, these are similar questions. Current yield higher than the coupon rate, meaning price is lower than 1,000. Price lower than 1,000 is a discount bond. So discount bond is price increase over time and reaching 1,000 at maturity. Okay. Right, let's skip those. This time value of money. Likely, which of the following bonds would be likely to exhibit a greater degree of interest risk? Let's compare first the three. 0 coupon and 0 coupon. All other things are the same. So for the ABC, A must be correct, right? 0 coupon. And for A and D has a longer maturity, so D should be correct, right? And again, okay, the bond, what bond is exhibited a higher degree of interest risk? The bond with either higher maturity or lower coupon rate. Okay, those two things to remember. If the bond rate on an outstanding, if the coupon rate on an outstanding bond is lower than the relevant current interest rate, okay, would be what? So coupon rate is lower than the current interest rate. That means the bond is selling at discount, right? And discount, that means the yield to maturity should be greater than the current yield. I'm just recalling that, right? Again and again. If this is a discount bond, its yield to maturity should be greater than the current yield because there's price appreciation that's not captured by that. And also, current yield should be greater than the coupon rate. So YTM should be greater than the coupon rate. Which one? That, okay, should be higher than the YTM should be higher than the coupon rate. Okay. Okay, that concludes chapter 6. Stocks. Some background information on IPO and then public offering and stock market. And read these, right? Read these in the textbook or slides. They're gonna helpful. So book value and liquidation value is not forward-looking. Book value is a historical cost that you make on the assets, and the liquidation value is you are selling. You are basically selling your property now, right? So you are giving up the future like profit generation from those assets. But market value is forward-looking. It doesn't look at the historical cost. It looks at how much value those assets can generate in the future, right? We use that to price a stock, right? The stock price should be forward-looking. And price. The advantages of market price is, okay, that considers all these. It considers earning power and consider the intangible assets like the experience and expertise of the management team and the patents and intellectual property. All these things are included in market price, which are ignored by book value or liquidation, and also value of future new investments. Okay, skip those. This is like how to use your industry average ratio to find your company's price, right? You can use your industry level market to book ratio and look at how much book value this firm has and then find the market value. This is a way to find the first method to find the market price, stock market price. But we are mainly talking about discount cash flow, right? Discounting cash flow method. So the value of a stock should be the future dividend plus some terminal price, which also the present value of future dividend, right? And divided by some discount rate. Okay, an example like this. During our holding period, we have this amount dividend, and we are expect to sell on this stock a year from now at this price. And when we discount those future cash flow by some discount rate. The discount rate is 13.5%. And after learning chapter 12, we know this discount rate is the required rate of return that is derived from beta, right? This is what we directly derive from CAPM. Okay. let's get that are similar, different unknown variable here. Okay. And we know this. Okay, current yield becomes dividend yield here. And we can use that to do questions. Annual dividend. Remember, it's annual dividend. This is not one dividend. It's annual dividend divided by stock price. And similar, right? So we have different unknown variables. We calculate for expected dividend, and we know expected return. We know expected capital gain, appreciation 10%, and then $50 current stock price. Calculate for dividend. Okay. Discount cash flow model for a constant dividend stock. Just divide the periodic dividend by discount rate, R. So that's a perpetuity, okay? Escape those questions, pretty simple, right? You can see these are all annual dividend divided by discount rate. And this is a constant growth model, right? Golden growth model. So DIV is the next dividend. The dividend that happens one period from now. R is this discount rate, and G is the growth rate of dividend. Let's skip that. And if we don't have, say, dividend, if that company is not a dividend-paying company, we can also use free cash flow. But they are essentially the same. We are just applying the golden growth model here. Okay, they are same. And sustainable growth rate, okay, is the growth rate, that is the G, right? The G. How to find that G? It is a growth rate if it plows back a constant fraction of earnings, maintain a constant return on equity, ROE, and keep its debt ratio constant. What does it mean? Okay. Payout ratio and the plowback ratio add up to 1, right? The payout ratio is the portion of income you earn during this period that you pay out as dividend. And plowback ratio is the portion that you put back into the company for future investments. So dividend is just payout ratio multiplied by your earning per share, right? So, and earning per share is just book value per share multiplied by ROE. Okay, so the growth rate, the sustainable growth rate is just a growth rate of a dividend. If dividend is equal to all these three, and if ROE is constant, plowback ratio constant, then the growth rate of dividend is just a growth rate of a book value, right? If these two are constant. So these are the the definition. The sustainable growth rate of dividend, if the firm's growth rate, if it plows back a constant fraction of earnings, maintain the same level of ROE, and keep that ratio constant. So all these are constant. So the growth rate of dividend is just a growth rate of a book value per share. And how to find the growth rate of book value? It is just the plowback ratio multiplied by ROE. Okay. And then we can get the G, sustainable growth rate. It's a plowback ratio multiplied by the ROE, okay, which is just the growth rate of book equity, right? Once again, so sustainable growth rate is a growth rate of a dividend. It is the same as the growth rate of the book equity if the company keeps constant ROE and constant plowback ratio. And what is the growth rate of a book equity? Is a plowback ratio multiplied by ROE. So that is the growth rate of dividend. I think you need more time to review that, and we go over too quickly. But the final equation is pretty simple, right? If you use that formula to do questions, you can see these are pretty computationally easy questions if you remember the formula, right? G is ROE multiplied by the plowback ratio. And okay, plowback ratio multiplied by ROE, 0.6 multiplied by 0.15. Non-constant growth, that is case when dividend, like they increase at different rate across time. So that's a little more complicated. In some of those cases, we have to use a complex cash flow function on the calculator. Okay. I'm not going over these questions, but if you want to discuss after the session, we can do that. It's a little time consuming. We are basically calculating each of the first 4 dividend, and after that, it becomes perpetuity, constant growth. Okay, so we are dividing the discounting, dividing the calculation into 2 parts. First, calculating the present value of the perpetuity, and the present value of these first 3 cash flows, and move them to present value. Okay. All right. Plowback earnings. Okay, skip that. All right. These are long and complex, but its takeaway is pretty simple. Plowing back will only plowing back a portion of your income is only profitable or only able to increase your future return if it can generate a future return that is higher than the expected rate of a return. So let's look at this. If there's no plowback, the price, if no plowback, all income are paid as dividend, right? So your price should just be your income divided by R. So that is easy. But if there's a positive, so let's look at this. If there's positive plowback, you plow back some portion of your ratio of your income, but your ROE is just equal to the investor required rate of return. Okay, the ROE is the same as R. Look at this. Price is the same as P0. That means you should not plow it back. You should not plow it back if those plowed back earnings can only generate a return that is as high as expected rate of return. Okay, see, ROE the same as required return. So the price should be just the same with the case when there's no plowback. But P will be higher than P0 if ROE is higher than R. That says what? Okay, the company tells you, okay, we are not changing, we are not making new investments, our ROE stays the same, but I'm going to leave some portion of our income for our future. And you as investors says, okay, that doesn't make sense. Doesn't just pay it back, because by plowing it back, it cannot generate higher return for my future. So why do I plow it back? Why do you plow it back? Right? Doesn't make sense.